Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to episode 224 of the AJ Brown Show. Today is February 20th, 2026. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ, who's been deep in the news headlines because we just got a big one right before the show started, and that's that the tariffs have been ruled unconstitutional or illegal, and so you're trying to figure out what's happening. Good morning. How are you doing?
Good. That's exactly. You guys, I showed up late into the preview room because I was deep trying to read the reporting. It looks like those steel and aluminum tariffs that Trump put on in his first term that Biden kept in place. I don't think those are affected by what's going on, but it looks like the reciprocal tariffs announced in April, as well as these tariffs against Mexico and Canada for fentanyl. Have been ruled illegal. I was reading the dissent by Justice Kavanaugh, who's raising a lot of alarm bells about the refunds that could follow this, because the U.S. has collected a big chunk of money in the form of tariffs. And I think that there's studies that are proving that a lot of those tariffs that have been collected have come from the American people. We kind of all knew it was going to wind up being a form of a tax on Americans, not really paid by foreign countries. But how do if you have to give that money back, that's going to be a huge hit on the economy. That's what Kavanaugh keeps writing about in his dissent. But yeah, I just want to know, Trump has been given a couple of loopholes where he can pursue the tariffs in different ways. I noticed that as well. So we probably will see that. But yeah, this could affect what's happening in the markets one way or another, right?
Yeah, and that's on top of some already juicy economic news that we got
Yeah.
before that. And then my follow-up question, I think we have a good guest on the show today to kind of
Yeah.
double down or
Perfect
have
timing.
the conversation on the tariffs. But a quick follow-up to that is, does it really matter? Because if Trump comes out in a couple hours and just says, yeah, we're just going to find another way to do it, like, the market's up on this news. And is it more of the idea behind it or the legal basis?
Yeah. I think it's for me. I think it's it's wait and see. As we were talking about before we went live, for me, it's more of, I just want to know what the playing field is so I can play in it. One way or another, I'm going to figure out how to navigate it. I'm going to look for the patterns in the broad market. I'm going to look for the patterns in my individual trades, and I'm going to go from there. But I just want to know, the playing field is once again changing, which investors and traders especially, don't like, because it means you've got to go back and redo your whole playbook. It's as if, you're the coach of a football team, and all of a sudden the field isn't 100 yards, the field is 50 yards.
Yeah, and that's kind of that sideways chop that we've been talking about,
Hmm.
where and so I just pulled up the S&P chart here for you. But we're heading up on this news, but once again, we're still in this middle area that we've had for the past 4 episodes, essentially.
Yeah, and
I don't know if you have any.
in fact, we might be consolidating, SIP. You need a couple more, moves from reversal to reversal to actually call a consolidation. But consolidating markets, if that's indeed what we start doing, are a sign of investors who are sitting on their hands, waiting for some piece of information. It actually builds psychological tension in investors, because investors like their money to be moving, right? And if it's not moving in the correct direction, they're going to tend to move it around in order to get it moving in the right direction. And so when you don't have the data, the information to be able to feel confident about putting your money one way or another, you kind of sit on your hands waiting for that information. And it's like a little pressure cooker building up pressure to the point where any sort of news headline, or dare I say, social post, Twitter, Truth Social, something like that, could trigger a bunch of investors. And of course, you've got the fear of missing out and the follow me tendency, keeping up with the Joneses. You see a whole bunch of money start following itself in one direction or another. A consolidation ultimately, especially if it's for a long time, leads to a breakout, whether up or down. So we'll keep our eyes pierced on that. But in the bigger sense, we're in this sideways chop, not able to get above 7,000 on the S&P. Perfect for our premium selling strategies, so long as we've got those protective trades in place. Yeah, a lot of other stuff happened this week too. You want to touch on that really quick?
Yeah, I do. But one of the, like, since you're talking on this point, and since we're an options show, this tweet I think kind of you know s- gives a story of what you're seeing from your perspective and your strategies, where options traders are the most bearish on stocks in more than 12 months after equity pull call ratio soars to 1.28. And so is this appealing to some of the premium strategies that you guys are discussing on a week to week basis?
Absolutely. I mean, let's also, should we pull up the VIX really quick? The VIX is, we've got some trades that we do on the VIX. We've got our hedging trade. The hedging trade hasn't reloaded. It hasn't recalibrated yet. So we're we don't have a hedging trade in place. We just recently January 20th or January 21st expiration, and we're waiting. But just notice that the VIX is creeping up. It's creeping up above that mean. We draw this best fit trend line on the VIX all the way from 1985 over the last 40 plus years, and that's around $19. So we're trading higher on that, but we're not above what I call our founded, unfounded fear threshold, right? The VIX is a measurement of anxiety, if you will. It's a way to actually quantitatively look at how much pressure, how much buying demand, if you will, is on options. And options, the main purpose of options, especially by the market movers out there, the 10% or 5% of those folks that control the 90 to 95% of the equity moving around in the markets, they're using them as hedges. And so when they have a demand, when they're worried in the short duration about something coming up in the windshield, right, they're going to stock up on that, drive the price of the VIX higher. And usually that's just a natural reaction to, CYA, cover your butt, right? Belt and suspenders. But when we start to see the VIX pop up above 26, a lot of times I call that the founded, unfounded fear threshold. That's where I see all of a sudden these anxieties are actually because of something tangible and real, right? So we're not there. We're just seeing that there's this buildup of anxiety. And that works, coming back to your original question, that works for us option traders, because if we're selling options, if we put ourselves on the side of the equation where we're selling options, we're making more money because people are out there wanting to buy options to cover their butts. So it's good to be an options seller right now.
That's right. All right. We're going to get some great insights from a veteran here shortly. But before we bring our guest on, AJ, I do want to run through some of the economic news that came out, maybe even
Mhm.
this week and today. But GDP and I believe PCE today. So we got, right, we got our growth numbers, and then we got our inflation numbers, and now we got to dissect it along with the tariff data.
Mhm.
And so, what is your? I mean, what was your initial take from the news?
I mean, today's PCE comes out. Remember, the PCE is what the Fed looks at. There's the CPI and there's the PPI, final demand. Those are great, but this is the report that, boy, I remember when Greenspan, he loved this report, right? The core PCE, so they factor out a lot of the volatile factors in our economy, and they take surveys of where prices are at for, everyday goods, and it's showing that inflation is ticking higher. And then I don't know if you got a chance, Sip, to look at the meeting minutes that were released from the last Fed meeting. Those came out on Wednesday, but basically what they said was, hey, the Fed is not thinking about cutting rates. The Fed might actually be looking out for this inflation that, again, this tariff thing is going to change things, but the tariffs were supposed to be a one-time bump, but maybe they're not. Maybe they're more of a longer term drag. So all of a sudden, when you look at the CME's, Fed target rate, their Fed watch tool, well, of course, this upcoming one in about a month in March, nobody's expecting any sort of rate change at that point. In April, the probabilities by investors have gone down compared to last week. There's probably not going to be any change. And now we're expecting a new Fed president, but we're also unprecedentedly expecting Jerome to stay on the board. A lot of times when Fed presidents retire, they're out of there. But there is a couple of times in history where the Fed president has stayed on as a Fed governor, and it looked, more and more. I think there's been a kind of animosity that has been created with Jerome, challenging his governor, whether this governor should be on that doesn't create goodwill. And so this guy's like, I better stay on. Since last week, it used to be kind of tending in June under our new Fed president that we would actually get a rate drop in June. Now it's almost looking, more like, again, it's going to be a holding pattern in those hints on Wednesday. The the PCE coming in. Also, there was some news on Thursday. I hate to be jumping all over the board, but there was some news on Thursday, which was our international trade in goods. And I think it kind of got a little hairy under Trump, because he's been talking about how these tariffs would cause us to start manufacturing things back here in Americas. His whole focus has been like uniting all of the Americas, South America, North America, and getting it so that it's all under his thumb, and that there'd be manufacturing here. We don't have to go abroad to Asia and Europe. And then you look at the international trade in goods, and for 2025, is it coming up? It'll come up. We actually have been buying more foreign goods than we were before. And I think there's a lot more than just tariffs. I mean, now you've got the whole there. It's so intermingled, but you've got like, foreign investment in the US dollar. So now you've got currency imbalances. This is where our guest, this is stuff that's really above my pay grade, but our guest has been watching this stuff for a long time. So I'm excited to see what he has to say about all of these different headlines and how it affects, the little investor, and how we invest affects our portfolio structuring.
Yeah, and so we could probably bring him on, but before we do, I feel like this is a great meme to represent how we're all feeling, AJ. Right? We're up, we're down, we're up, we're down, we're up, we're down. What's going on? And so we're gonna try and unravel a little bit of that with our special guest. So let's go ahead and cue him up. Today we're joined by Jim Barrineau, a veteran investor with more than 25 years of investment experience, probably a little bit more. Hedge funds, IRAs, institutional portfolios. Currently, he's serving for a foundation, and he writes a very, very interesting Substack, which is kind of what caught our interest. And so, Jim, welcome to the show. Thank you for joining us. How are you doing on this very news-driven Friday?
Great. Thanks for having me. Very, very busy. That's how I'm doing.
Okay, so AJ, do you have a question that I imagine we would want your take, Jim, on what's happening with the tariff stuff?
Yeah, give us your take on the tariffs, as well as a lot of this economic news that was released in this shortened trading week. Remember, Monday was a holiday, so we're just talking about 4 days here this week, but it's like a month or so of compared to what we've seen in the past years.
Yeah, so let me go through the big stuff. The tariff thing, I think we're going to unwind a little bit of this rally, because there's just too much uncertainty. You were talking about how people just do not like uncertainty and step back. we got a nice pop, but God only knows whether they're going to be resurrected under a different authority. I think that's going to be the game plan. They may not come at the same level. It's just too hard to game plan that at this point. So, nice pop. I think we'll give it back. I don't. It's obviously good news for the macro economy, but we're just going to have to wait and see what happens. So the other two big pieces this morning: GDP, big miss on the downside. What I think the people who are forecasting GDP missed in their miss is the trade deficit, the numbers which we got yesterday. So if you remember earlier, maybe 4 quarters ago, it looked like the trade deficit was going to shrink. And that was because importers just hit the brakes really hard. So that contributed to positive GDP numbers. Remember, international trade's a big piece of GDP, which people tend not to focus on quite as much as the consumer, et cetera, understandably so. But in the last couple of quarters, as we saw on Thursday, the trade deficit is basically right back to where it was a year ago, almost to the billion. So we've retraced a lot of that. People learned to live with the tariff, imports picked up, and that's going to take away from GDP. So in the fourth quarter number that we saw, it's reflective of that, and also a little bit softer consumer than what we've seen. But if you look at the consumer sentiment numbers, they've been terrible anyway. Lastly, core PCE at 3% is the highest since I think early 2024. So I was on the phone with a friend of mine who runs a bond hedge fund, and he was saying, I think this is going to be good for long bonds. And they initially popped at 830 because of the slow growth number, right? People thinking the Fed rate cut probabilities are going to rise. But then the market started to digest that 3% core PCE number. And let's assume tariffs come back at a slightly lower level, or a lot of it doesn't come back. That's good for growth. So there's really no reason for bonds to rally here. And I think that's been one of the supporting legs of equities, is a great bond
market. That's a lot of insights. That's good. A lot of that's a lot better news than the panic that I have, and that a lot of panic that retail, or even the little guys like me, we don't know what to take from some of this. So it's good to have your 2 cents. Let me ask you. So you're doing foundation work now, right?
Yep.
But you've worked in hedge funds, you've worked in, institutional portfolios. How has that shaped your definition of risk, and how is that kind of different from when you were working with the hedge funds to what you're doing now with the foundations?
Most of the institutional principles I kind of grew up on Wall Street, I bring to the foundation, but I run it in a different way, and maybe we can touch on that later, than you would run a typical mutual fund. I managed a mutual fund in a lot of different separate strategies when I was on Wall Street. I think it was $6 billion at the peak. So risk is a different concept there. There's the risk of losing money, volatility, obviously. You're an expert on that, being an options guy. There's a risk of permanent loss of capital. Everybody knows that. You buy a stock that goes bust. But there's an additional risk that has to be top of mind for a professional institutional investor, and that's keeping up with the index. So, the incentives are stacked on Wall Street to not be too much of a cowboy relative to your own index. You get paid a bonus at the end of the year, which is a huge chunk of your compensation. And the first thing your boss is going to look at, and your investors, is how you did relative to the index you managed against. So in a professional environment, that mitigates against taking a ton of risk relative to the index. So you're essentially long most of the time. I don't think it's fair to say everybody's a closet indexer on Wall Street, but it's top of mind when you take a risk that deviates from the index. You're very aware of that, and you have to mitigate that with hedges and other parts of your portfolio. So you have to be very careful, and it's just a different way of managing stuff that, a retail investor wouldn't normally, wake up in the middle of the night and wonder where he is relative to the S&P. So I started managing this foundation. I'm a member of the board as well in 2017.
Okay.
We started managing it first as an absolute return vehicle. My background's mostly in fixed income. That was pretty easy. We just wanted to make 5% plus. Long story short, in December, the board voted to allow me to be a little bit more unconstrained. So I'm incorporating the principles that I wasn't able to incorporate when I was running a big chunk of money on Wall Street, meaning I'm unconstrained against the index. I manage with some objective price indicators, with some objective fundamental indicators. I want to beat the S&P, but I don't really care to hang around the S&P unless I see it in my portfolio framework, which we can go over in a little bit. But that's where we're at. We're up about 6.5% year to date, so we've done pretty well. So it's a blast. I'll never not be trading the markets because that's what I do.
So yeah, so I want everybody who's following our show, I know a lot of you out there are active traders, but you start to amass, especially once you get to a point where you're covering your expenses and now your portfolio is growing. But it gets to a point, I know with my option strategies, I get to a point where I have to be careful of being too much liquidity. And so, there's only so much cash I can put into my options trade and then be able to stay sane. So I've got this big chunk that's growing, and I want to put it into more of a long-term portfolio, like something you're talking about. So you've been mentioning about how you would structure that. Do you want to go into that now?
Sure. So that's a great strategy and a great way to think about things. I trade options for my personal account. So, whether the ratio is 20% of your wealth, your investable wealth in options, 80% long-term, however you feel comfortable doing it. Think of the long-term as more of I want an 8 to 15% kind of return. I want it, to be steady. I want to be able to sleep at night. And that allows me to take risks in my options trading, and I can have some place to shift my profits. I can grow that account. It'll grow organically. And then you're just set. For me, one of the most important concepts in investing is psychological comfort, whether it's, an option strategy where you have defined risk, or it's a portfolio where you have a defined downside protection protocol in place. So what I've done with the foundation that has been very successful so far is I have three basic principles. One is my holy grail in fundamentals is market liquidity. I don't care about valuation. I don't care about economic news or growth. I care about liquidity. Right now, we're in a very liquid environment. The go-to thing I use. It's the Chicago Fed's financial liquidity indicator. It gets updated every week on Wednesday. If you pull up that chart on the Chicago Fed website, you'll see that in post-COVID, we had a rush of liquidity. 2022, the Fed began to raise rates, and the definition of liquidity is not just the Fed, it's a bunch of credit indicators, credit spreads, 100, literally 100 data points go into this. 2022 liquidity contracts. The S&P was down, I think, 18% in 2022. Then the Fed gets to the peak of their hiking cycle. The Fed starts to cut rates. Since then, now we have credit spreads at historical tights. We have expectations that the Fed is going to cut some more this year at some point. So can you make that a 5-year chart? You will see that on the left there at the top. There you go. So,
oh, wow.
Lower is looser. So this is the environment we've been in. We've had, 2 years of 20% plus returns and then mid-teens return in 2025. That's what abundant liquidity gets you. Okay, so that's why if we're in a highly liquid environment, I'm going to be predisposed to take on more risk. And some of the intermediate things I look at are Fed rate expectations. You pull up the CME, I follow that religiously. If the market begins to think that lower and lower chances of the Fed cutting rates, what does that mean? Liquidity is not going to continue to improve, right? The other thing I look at is high yield debt spreads. If high yield debt spreads are creeping up, and they have been over the past couple of weeks from very, very low levels, that means liquidity is tightening ever so slightly. So it's something to be aware of. So that's principle one. That's kind of my go-to. And it really, I've been doing this for 30 years or so. I'm a huge fan of simplicity. So that simplifies everything. I don't really care what Goldman Sachs forecast for the market is. I don't care what, everybody's forecast for GDP growth is. Tell me what liquidity is going to do. So principle one. Second principle is I have an objective price measurement. So there have been a number of academic studies that show, generally people are told, buy an index fund, hold it for 40 years. But there are points at which if you have an objective price indicator, if you take it off and maybe buy treasuries with a part of that as you hit that price indicator, and then go back into all equities when you go above that price indicator, you actually do better than the market as a whole. So what I use is a 20-day moving average. It's not an absolute black box, but if something is below the 20-day moving average, I'm going to sell it, or I'm going to hold less of it. So triple Qs and SPYs are right now below the 20-day moving average. I've reduced my exposure to them. You can see over the past month, that's worked out really well. And the other thing that I do that very, very few institutional managers, if any, would do is I move some of my equity exposure from SPY to a covered call strategy when we're below the 20-day moving average. So I don't know when stocks are going to rally. I need to have some equity exposure, but if I do a covered call strategy, I'm going to outperform the S&P when I'm below the 20-day moving average. The only way I'm not going to outperform is when the S&P, goes up very, very strongly. You know this very well from your options work. And
absolutely.
If we just tread water, the chart you guys showed previously, well, this chart shows it perfectly. Over the past 6 weeks, a month, a covered call strategy is fantastic for this environment. So that's one principle I use. The other principle is I'm not tied to the index. So value stocks ripped over the past 3 months. I was very heavy in value. They were well above the 20-day moving average. They still are, but they're weakening relative to the S&P. So I've started to take risk off there. International ripped for the past 3 months. I've started to take a little bit off there as they've come off. I still have a good chunk of emerging markets exposure. All of that is still below the 20-day moving average. I haven't been incredibly aggressive with that. So it's a super simple indicator, right? I like to make as few portfolio decisions as possible. The more decisions you make, the more you're going to be wrong, the more you're going to be stressed, the more you're going to be susceptible to making, emotional swings on something. Like you saw that tariff news at 10 o'clock, things popped. If you're super emotional, what are you going to do? You're going to follow that pop. I would guess we've probably unwound, 60% of that 10 a.m. pop. I'm just guessing. I have a shorter chart in front of me, but so I try to keep the emotional stuff out of it. So those are the principles I use. It also the 20-day moving average also serves as downside protection, so I can take more risk in the portfolio on a structural basis, because I know if we get below the 20-day, I'm going to start shedding that risk. So those are the principles I'm using. They're working out super well, and that's how I do it.
AJ,
So
I have a
that's real-
question.
Yeah, you do it.
Well, so when you mentioned your background, Jim, you said fixed income. And when I hear fixed income, I hear old school. But given where we are in 2026, I see in some of the notes that you got there's AI, there's crypto, there's these predictive markets. What are your thoughts on those, and are you shying away from them, or is there opportunity there to mix in with a little bit of speculative percentages?
Okay, well, I'm going to answer that in a way that I hope will convince you I'm not too old school. Let's start with crypto. So I am in the middle camp of crypto. There's the guys who think it's amazing. It's going to go to 2 million. It's an essential part of the financial structure now. It's going to be great. And then there are guys who say it's going to go to zero because it has no use. It's just a speculative instrument. So I am right in the middle. And again, here's my price stuff at work. During the time I've managed its foundation, I've probably invested in crypto twice. Actually, by coincidence, yesterday is time number 2. So I very rarely buy stuff that's below the 20-day moving average. Crypto, obviously, well below the 20-day moving average. However, in the last week and a half, you can see it's kind of trying to find a bottom. So what I've done there is to buy a covered call fund on crypto. It'll be highly correlated to crypto. If crypto just rips from here, I'll capture some of that. That's great for me, because I'm also looking for things that are not correlated to equities, but promise a positive return with the major indices below their 20-day moving average. So check that box. Bitcoin looks like it's, that's a great chart. Trying to find a bottom. Check that box. Buy a covered call strategy, high yield. If it just drags along this bottom for a month, I'm golden. If it goes down, I'll outperform Bitcoin. Obviously I don't want it to go down too far. The only scenario I'm quote unquote worried about is if Bitcoin rips. So it is an inherently speculative instrument, but it's an instrument with a lot of liquidity that you can trade. So the price indicators that I use work just as well on Bitcoin as they work on everything else. So I'm not going to be dogmatic about the view there. On prediction markets, I guess I am going to sound old school here, but these are markets that are incredibly manipulatable. So it's kind of like sports betting. Everybody likes to, lay a little money on their favorite team, but in an illiquid predictive market. So, give you an example. When people talk about predictive markets, they love to bring up the predictive market about, will Jesus have his second coming, in 2027? Okay, that's something you can bet on. But there is a derivative market now that says, will the odds of Jesus coming for a second coming be above 5%? Now, if I'm a hedge fund guy and I got $500,000, which is like 0.5% of my portfolio, I might be interested in that derivatives market right after I place, 300K on Jesus' second coming that turns it into a 10% kind of probability. So the ability to manipulate those markets is just spectacular. I'm not sure they're going to be liquid enough for serious institutional investors ever to trade in. I know they're trying to roll out some ETFs like bet on a Democratic president in 2028. The ETF either soars or it goes to zero. That stuff, I just don't want to play in. It's impossible to dimension the probability of return on that. So I just stay away.
Or risk on that, for that matter.
Yeah, here's a good one. Prince Andrew sentenced to prison, 13% chance. That's a betting stat for the week. But you're right, they're all over the place. AJ, anything you want to add?
Yeah, I've got two last questions. The first question, this is about your role, you personally. So you've got AI coming, right? You've got fee compression, you've got consolidation, all reshaping this whole financial picture. What skills are going to define the next decade's elite investors that are running portfolios?
Well, you need to be AI fluent. There's no doubt about it. So, are you aware of an app called Trade GPT?
Yeah.
Yeah. So I've played around on that. It's very nice. I've had it suggest options trades for me. That kind of thing. I think what we're going to see is information compression from AI, where an investor, doesn't need to spend a ton of time scouring for information on companies or macro or market structure or even technical analysis on the market. So that's a big plus. Any portfolio manager is going to need to know how to do that. You're going to need the guys who work on your team to be able to do that. And a lot of the back office stuff is going to be, taken over by AI. So the actual team is going to be leaner. But at the end of the day, you're never going to substitute for judgment. You're never going to substitute for behavioral finance foibles, emotional responses to the market. And I don't think you're ever going to be able to predict, specific market movements because it's run by irrational human beings. So
a 25-year-old who's just graduated college, what should he be focusing on if he's going to get into the finance market to ultimately be a U when he's 30, 35? What should he be doing?
So aside
from AI,
in AI, you have to be fluent with every single tool out there, and you really have to have a strategy for maximizing the impact of AI. And to maximize the impact, I really think you're going to need it to make the funnel of information you want to trade on very narrow, very quickly. Okay, if you can do that, you've used it very well. But again, at the end of the day, you still need an investing framework. What information are you after? What type of information? What do you think is tradable? What do you think is impacting your market? If you make a wise decision on those building blocks and then use AI on top of that, it's going to be a real boon to you. But the basics of investing are always going to be, knowing yourself, having some emotional awareness, behavioral finance, and having a portfolio framework that you're comfortable with, that works for you, and then use that as the starting point for how you want to use AI.
I love it. I have one more question, Sip, and this has to do with I've been reading. So everybody should know Jim writes a Substack that you all need to go subscribe to. We'll put the link at some point either up on the screen or in the chat or a little bit of both. But I've been reading some of your more recent Substack articles, and the one thing that has kind of a thread.
I think we lost.
Oh,
Sorry, we lost you for a second.
AJ, backtrack about 30 seconds. We got you somehow you got booted. What do you love about the Substack?
Okay, so I've been reading a lot of your articles, and there's definitely been a thread. Your writing blends a lot of short-term tactical observations and then long-term strategic positioning. So I guess where I'm coming from after reading about 3 of your more recent articles, and everybody needs to go subscribe to this, by the way. How do you separate that signal from any signals from the noise?
So the structural component is a liquidity component.
Yep.
And then the tactical signals are, objective price indicators. So when
talked about that,
so I'm extremely focused on finding stuff that trades above its 20-day moving average. So this week in the foundation, to give you an example, I'll be writing about this over the weekend. With the 2 major indices below their 20-day moving average, what can I do to make money while I wait for these indexes to kind of break a range and get up there? So there's a trend following fund that I bought that gives you access to currencies, bonds, precious metals. I bought a covered call fund on gold, covered call fund on oil, both of which are above their 20-day moving average. And I bought a currency fund that basically goes long emerging market currencies, short developed currencies. That's well above its 20-day moving average. That's doing great. So that's about 20% of the portfolio that is completely uncorrelated to equity markets. The rest of it is very correlated to equity markets. So I don't want to be too bearish on equities with liquidity being this abundant. So basically, it is a tactical cautionary thing I'm doing, but I've had a pretty good week in the foundation in terms of returns. And the thing I don't want to miss is days like today when the market pops up and I've been too bearish, and then I'm emotionally wanting to chase it. So
Sure.
I do have that covered call equity input. I have emerging market equities. I have some international equities. So I'm not getting left behind, basically, even while I'm diversifying. So so you would expect a foundation to be, our time horizon is infinite, right?
Yes.
We're going to be around forever. So why don't we just be in equities, and then we'll wake up in 40 years and we will have done well. That's not the way I want to run it, because we are in an environment where everything is massively priced to perfection if you look at valuations. So I'm not going to trade on valuations, but you can't help but notice valuations are historically high. when they're this high for the next 10 to 15 years, you're going to get, low single digit kind of returns. That's the way history works. So I have that strategy in the background, but you can overcome that if you have a reasonable objective price discipline that allows you to avoid the downside and stay invested when equities are doing well. And then you take all of those short time horizons when that happens, add it up to a long time horizon, we will be in much better shape than if we had, bought and went to sleep for 40 years.
Excellent. I love that you're using a lot of the, I talk to a lot of our investors that come to us, traders that come to us that constantly want to take on and off trades. And I'm like, you know, we don't know if that's just taking a pause. Let's put a collar. Let's go ahead and use a covered call strategy and just kind of surf until it picks back up, and rather than just taking the trade off. So I love that you're doing that on the macro scale there. Sip, anything else?
No, I mean, we got to run through some of our strategies and our setups for the week. But Jim, we did add the link to the Substack in the chat, so everybody should go check that out. If you want to hang around, give us some input on some of these names. We've got AJ's pick of the week, and then we've got our speed round. We could run through these rather quickly and get back to the Olympic hockey, right? If anybody's watching that.
Absolutely. Yeah, I'll stick around, and I'm very grateful for you doing the Substack promo.
Yeah.
As always, in addition to Jim's Substack, we've got AJ's quick links. I went ahead and threw that in the chat as well. That's got all of AJ's goodies, that indicator suite that you'll probably see here, along with just a ton of information. Hit that like, hit that follow, hit that subscribe. Give us some love. All right, AJ, your pick of the week last week was Macy's. I believe we're sticking to the same sector this week. Your pick of the week is Gap Incorporated, ticker symbol GAP. What are you seeing here?
Well, okay, so Gap, like Jim mentioned, there had been this huge chunk of money leaving the more speculative AIs that, a lot of times by the end of last year, completely overbought. So, and worries about, .com bust memories, things like that. So a lot of money has been flowing into value trades. Now, I've also seen that money kind of start to shut down 2 months into this new year. But Gap is one of those companies that kind of checks off people's boxes of, hey, since I don't want to, I want to make sure that I'm investing in companies that seem to have been around for a while. They have a history. So I'm looking at Gap fundamentally as a good symbol for us to think about. I just pulled up my retracement analysis on it, and we're on even though today, again, with what's happening today, I think, you've got a lot of external headlines affecting kind of the organic or the pattern-based price action. So we'll kind of let that digest and get in our rear view mirror for next week. But we're at the bottom of this ascending channel, and I'm actually looking for an opportunity. Again, I got my signal. You guys remember I'm an end of day trader. So I got my signal yesterday evening that said, hey, we might be at the bottom of this ascending channel. I'm using that fast MACD calculated on volume weighted average price. I looked at some additional data points, patterns. I looked at volume, and I went ahead and said, yeah, I'll try to, if I see the momentum on today, I'll see if I want to open a position. So far, based on what we're seeing for this morning session, I might not be opening. I might let the weekend go by and think again about this on Monday. We'll see what the afternoon session brings, but I'd love to get into a position on Gap. That's what I'm looking for. I'm making sure, all the planets align with all of my check boxes, but I'm either thinking about buying the stock itself, currently trading around $28.15, as you can see on my screen, 28.19, or there's a call option that I could see as a good substitute. Now I'm going all the way out to September. You might think I would want to go out even further, but right now the markets could be topsy-turvy on a moment's notice. I don't see any of my positions that I usually would have going out, 8 months, 9 months. I don't see them lasting that long. So if I'm going to set up an initial covering position or initial position, I'm okay just going out to September. But September's pretty far out there, and I'm looking at that $18 call. So just an idea. Again, I don't want to do anything till I get all my signals aligned. But then once I have that, I'm going to go ahead and kind of talking about what we were talking about earlier. As I get moving up to the top of the channel and get one of those end of day top signals, rather than thinking about just liquidating that position and writing that, I would instead be thinking about selling a call. And in this case, since we're in an ascending channel, I wouldn't just sell an at the money call. I'd sell a call that's somewhat, out of the money, and you won't get as much payback on it. But at the same time, you also, if we move up higher in the channel, since it is an ascending channel, you also won't get knocked out. So you're going to do that balance. And at the same time, I'm going to use that money from that call to kind of subsidize a protective option should a reversal play on us. So that's kind of my strategy moving forward. But before we can do any of those, it's called collaring. Before we can do any of that, we need to set up an initial covering position, either the stock or a deep in the money, far out in time call option. And so that's what I'm looking on entering. That's my excitement about Gap. Interested to know if Jim has any ideas on Gap.
I like this trade, and I like the call, the way you're going about the call thing. Yeah, it's got a really nice chart. I think it's kind of a little bit one of those under the radar things that can keep going. And we have to remember that the economy is in great shape. We do have a lot of liquidity. So, yeah, I really like this.
And then AJ, I guess if you threw the 20-day on there,
You want me to do that?
I mean, it's a recurring theme. If it's above it, we're feeling good about the opportunity. But
I pulled it up. Yeah, it's above the 20.
Hey, there we go. There's our validation. Along with a handful of other things. There we go. Look at that.
We've often talked about in my program, for those of you that when I meet with my program participants, we talk about how my chair just let go on me. We talk about how market movers, and I would actually consider Jim as one of those market movers out there, right? How they're moving kind of, us as retail traders with our small investments, we're like little tugboats, and he's an oil tanker, right? So he's got to make very strategic decisions because he can't turn his boat on a dime, right? So instead, he can do a covered call strategy or something like that, whereas we can do all these little trades. So it's funny as you talk about the keeping it simple and using the 20-day, that totally aligns with what my avatar is of a big, somebody who's moving as much, even your foundation's fund, moving that kind of money around.
Awesome. All right. So, AJ, we've got a couple of names in our speed round that we could probably breeze through. We most likely don't need the full breakdowns, but, we've got 5 minutes. So let's see if we can crank these out. Our first name is an interesting one that was in the headlines, at least from my perspective. Deborah out of Denver, Colorado, is interested in Palantir, the big AI tech company, which I believe the news headlines this week where they left Colorado and moved their headquarters to Florida. But, does that present an investment opportunity?
So this is one of those stocks that probably, it's been in the news, right? It's one of these ones that's in the news, which means I'm kind of shying away from it. I like the ones that are boring, under the radar, ones that aren't going to get affected by news headlines one way or another. But with that said, I'm looking at the chart, and I'm looking at, I guess, Deborah, you're asking, do I see a bottom? And is this a time to go long Palantir or substitute options? Listen, I can give you a whole bunch of technical things to look for to see if indeed there's a reversal. And when I'm looking for a trend reversal like this, most of mine are so lagging that the trend reversal will be a week or two in effect before any of my things jump in. But I've got so many other opportunities, Deborah, for us to invest our money in things that I would almost say I've got lower hanging fruit than to follow something that is in the news like this. But I'm interested. What would you put this into circulation in your portfolio, Jim?
No, and the reason is it looks like it's gotten crushed, right? 2 years ago, this was at $20. It's at
Hmm.
$134. So you need to have a little bit of a long-term perspective. I just think the AI related stuff is radioactive right now. Nobody can have an edge. Yeah, we might have a short-term, bottom on Palantir, but you better be incredibly nimble and you better have a stop loss, ironclad stop loss in place because we've retraced a little bit. We can retrace a whole lot more if the AI stuff gets ugly.
Yeah, especially when you go back to that $20 a share not too long ago. I mean, in the rear, like we can see where it was in the rear view mirror. Okay, AJ, let's add one more and then we can close things out. I feel for today's episode. Kelly out of Flagstaff, Arizona, similar industry, Micron, ticker symbol MU. A little bit of a safer play or no?
Well, Micron, so different than just being an AI play, straightforward AI play. Micron is kind of the infrastructure, right? They're a memory maker, right? If you go, for those of you that build your own computers at home, they're the name behind Crucial, right? Crucial is those memory sticks we all buy and stick into our desktops. So yeah, Micron's a memory, but yeah, their stock has shot up because all of these data sensors need their memory. Um, so I guess you're wondering, should we start some sort of position in here based on what you want to set up in an initial position, Kelly, and then try to sell premium on this? Here's what I'm seeing. I'm seeing that very similar. Let's take a zoom out. Uh, let's go back, and very similar to what we were just talking about with Palantir, where this thing in stasis before all this excitement was trading $125. It's now up at 450. What I'm seeing now when I look at the bigger picture is actually a consolidation, right? We're starting to see this consolidate again, like we were talking about with the S&P 500. Investors on Micron don't know whether they should be continuing to buy or continuing to sell. So they're kind of, they're in this stasis, and it's getting a consolidation, meaning that the support is ascending, we're coming to a pivot point where ultimately there might be, I don't know if it's going to be a news headline or something, it's like a tinder into the pile of oily rags, and we don't know, at least I don't know, I don't have the information as to whether we'll see a breakout up or breakout down. But I don't know if I want to do anything with this unless you want to get into maybe some sort of straddle strangle type thing, or you want to kind of try to play that volatility rush that we'll see build up over the next weeks as we go to that pivot. You got to be very nimble on this one too. I'm not sure it would be something I like. I'm old. I like the safer trades these days, the ones where I can just kind of, I don't, this is not my cup of tea, but that's where I would be going with this. I wouldn't be trying to set up a range bound strategy that I would think that I could make money off of this over the next months. I think this one's getting ready over probably the next month or two to have some sort of day of reckoning one way or the other.
I mean, it was just at 100 before the holidays. So,
Yeah.
uh, yeah,
Overbought big time.
I'm assuming this is a pass for you, Jim, seeing as unless you got in a couple, months ago.
It's funny. I have a little screener. I use my personal account for the 2-day RSI, where if the 2-day RSI is above 97%, it triggers, and stuff is very rarely that high in the
Yeah.
RSI. But Micron triggered it. I did a bear call spread, um, lost money, rolled the spread. I eventually made money. Um, but I think, to AJ's point, that a strangle, a straddle, a bear call spread here that's pretty conservative um, might be the thing to do as this consolidates. But, this part of the market has just been absolutely on fire. It has to take a breather sooner or later. It looks like we're starting to take that breather. So maybe you just, take advantage of the stock treading water for a while. That would be the only strategy I would think of using here.
Mhm.
All right. Well, that's our speed round for today as we wrap up the show. I do once again want to bring attention to Jim's amazing and very informative Substack. The link to this is in the chat. As we close the show out, Jim, any final words to the viewers out there, given your expertise and um, the viewership of being a little bit more conservative and risk adverse? What are your final thoughts?
Just have price discipline, have some kind of objective indicator that takes emotions out of the trading a little bit, and you'll see your results improve dramatically.
Jim, how do people, if they have a chunk of cash, might be speaking for myself here. How do we get into your foundational fund?
Unfortunately, you can't, but I do consulting for RAs and family offices. I'm happy to do consulting for individual people. I put my personal email on the Substack. It'll be
Excellent.
in next. I hadn't been doing that, but it'll be in this week's Substack, and people can reach out. Well, let's talk about it.
Great.
Awesome. Well, we appreciate your time, Jim. Everybody head on over there and check out that information. And, we'll see you on the stream and enjoy the weekend and stay safe. And I hope you watch, USA win the gold medal this weekend in that men's hockey.
Thanks, guys.
Thanks, James.
All right, AJ, closing out the show.
That was good. That was really good.
We definitely went down more of the psychological route rather than super technical like we have in some previous instances.
Yes. And you know what? You got to stick to, and this has been the theme in my program this week, is all about the steps of your process and how you're doing the steps might be being adjusted based on what's happening, but your process, your discipline, and the timing of your process, it all stays the same. So if what I'm finding, because a lot of people are having troubles right now navigating the markets, and what I'm finding is that they don't have those processes in place. They've been so focused on how to do things that it's not that stuff isn't working. Uh, you've got to be able to be flexible in the how, but the timing and the actual, that's where you fall back on your discipline. So no matter what the markets are doing, those processes stay the same. And if you don't even have the processes, it's maybe the first thing you look at when things start to go into the toilet.
Yeah, I like your analogy of the oil tanker, right? Like, oh, we've got one of the drivers of the oil tanker, so now we know how they navigate with big, huge vessels and amounts of capital through the day-to-day turbulence, right? And so it's good to get that perspective. So
It really is.
We highly encourage everybody to head on over to the Substack. The link to that is in the chat. Also, the link to AJ's quick links is also there, where you can get access to all the wonderful stuff that AJ and the team is doing over at Trading Trainer. Yeah, I mean, I've been hyping up this gold medal game. I mean, I'm just excited to finally. I don't know. Have you been watching the Olympics? That's kind of the background we went with here. For the today's show, because I've been watching it. A lot of curling is my one observation.
Yeah, there's been a lot of curling. I really am into the slalom. That and the ski jumps. Oh my goodness. Oh, I caught some of the skeleton. I don't that is I see I have a survival mechanism, Sip. So I'd never be able to go down at whatever speeds they're going down face versa. But man, it's cool to watch. I'm glad that there's people out there who but I've got this little voice inside of me that says don't do that.
Well, one of my good friends is Slovakian, and we play hockey together. And in a few hours, it's the USA Slovakia
Uh
semifinal game, and so he's super hyped up. And so it could be USA Canada in the final, which would be very interesting given our recent tensions around tariffs and whatnot. But
yeah.
that's what I got planned for the weekend. Any final words, AJ?
No, that was a great call. Great podcast.
All right, guys, enjoy the weekend. We appreciate it. We'll see you next week.
Take care.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content